Hey, what's up, good people? How you doing? Welcome back to Stock Up with Larry Jones. Go ahead and do what that ticker is telling you to do. Hit the like, subscribe, and the notification bell. Let's get right into it. Anything I say is not a suggestion for you to buy, hold, or sell. All right. So we're just at the time of filming this, we're literally 2 minutes before the close. The market is selling off. There's a lot of news going on. There's a lot we have to talk about. All right, 2 minutes to close. Let's just take a look at what's going on. We got energy. Okay, we'll come back to it. All right, so market is selling off towards the close. It's just dipping right to the close, and we've had weeks of that before in the past, right? There's a lot of talk now. Like I told you guys a few days ago about, what the market is saying about an upcoming recession. Now, the recession really, by all accounts, is not expected this year, but more like Q2 of next year, right? And everything is on the Fed right now. Look at the volatility index. Look at that. It's up almost 10%. Look at the Dow, the S&P. The Dow literally is tanking like 200 points in the last 30 minutes, right? Just chasing this stock or that stock and wondering why it sold off. This is why it sold off. There's a lot of uncertainty in the market. As a matter of fact, let me play this video. Well, I'll play it later. Let's discuss a few things first, right? So let's just talk about a upcoming recession, okay? And why you should not be scared. You should be prepared. Favor inflation measure increases to a 5.4 annual rate in February. It went up from 5.2 to 5.4, right? And let's see here. So let's look at the S&P. Let's look at what the S&P has done year to date, right? The S&P has come down from its highs, and it is down about 2%, right? I'm sorry, 5%, right? But from its highs, year to date, so the beginning of the year, from its highs, it had fallen, look at that, 13%, right? But from the lows, it has risen 11%. And we see what's going on. Let's drop in the Dow and the NASDAQ, okay? And as you can see, though they are up for the month, they're actually down for the year, right? And they're way down off of their highs, their session highs, right? So when we got up here, we came down here. And I'm just really thinking that, remember, this is March of COVID, the first COVID, right? We were running up and it came down. We literally could just give back all of these gains, it seems like, as we, trend our way down, right? And so we know that the Fed printed a lot of fake money that caused the market to, it's like being hyped up on sugar, right? It ain't real. It's a high. It's going to drop you down. And so that's what we're looking at. But I want to let you guys know that there is time before a recession happens, and there's a ton of money to be made before a recession happens. There's lead indicators and there's lagging indicators. To me, these are lagging indicators. High unemployment rate, right? We know we have a lot of jobs out there that are unfilled, and a lot of people are just not returning to the work market. Feds are talking about, they already said 7 times at 25 basis points each, right? But the Fed is saying, but open to 50 basis points. And me personally, I now think that they're going to have to raise it by 50 basis points 2 times this year, all right? Maybe not in April, but by May, they may have to go to 50 basis points. That's not going to be good for the market. And I believe they're going to have to do it again because they need to be at 0 Need to be at -0. All right. So Larry, what happens? Like, should I pull all my money out? I never been through a recession. I have. And I will tell you that, I've shown you guys this before. About 11 months is how long the average recession lasts, right? And after the inverted yield curve, after the yield curve inverts, meaning the 10-year and the 2-year inverts, then generally around 14 to 16 months after that, then we go into a recession. Okay, so it has happened every time that has happened. And so that puts us in the, Q2 of next year ish. Could come a little earlier, could come a little later. I think it's in a range from 14 to 18 months, right? After. So do the math. So that does not mean that it is written in stone that it's going to happen at that exact time frame. Okay. Now, there's some bad things that could happen that could force an early recession. So I got to be honest with you guys and let you guys know that could have forced us into an early recession. And the flip side of that is a recession could be averted. And now it's all on the feds. Okay. Now, some people are not just bearish. Some people are neutral on what's going to happen. So let's listen to this really quick. It's only a minute and a half, and we'll take it from there.
If you look at the AAII, American Association of Individual Investors, bear versus bull ratio, we highlighted this at the time. It was at multi-year lows for bullishness, therefore multi-year highs for bearishness. And, the takeaway from that is the market usually does not have a further downside to go, at least not significant downside immediately when that's the case. You could go back to instances 2016, late 2018, where you saw similar declines in optimistic sentiment. And then once it's gotten back to the flat line, which is roughly where we are right now, it has not necessarily meant the end of a rally. Now, things moderate, maybe they chop around a little bit, but usually once you've gotten that pessimistic, you can sort of feed off that in the market for a little while beyond that. So it seems a net positive. It's no longer as much of a tailwind. Sentiment isn't as it was a few weeks ago. What is interesting, though, Sarah, is the reason that you've seen this ratio go up is because people are no longer saying that they're bearish. They're more saying they're neutral. It's the highest neutral rating that we've seen in something like since the early 2020, which shows you that, there's a lot of cross currents. People don't know how to figure it out.
There's a thing called rotation that is something we're going to be talking about from here on out, right? Meaning the stock that we need to be rotating or the sectors that we need to be rotating out. Remember, we called it right last year. We rotated into banks, into energy early, right? Before a lot of people start selling their entire portfolios, we took profits and we rotated. Now, this is not for you to be fearful. This is to let you know what's to come so you can be prepared. So what I want you to do is Google what stock or what sectors fare well during a recession. Now, we don't have the high job loss and all of that. We don't have high unemployment because, if you want a job right now, you can go get a job. That's the truth. We have a lot of unfilled jobs is our biggest problem. But there's a looming problem with mortgages, okay, and supply. So there's not enough homes. And so when the feds increase the interest rates, it makes it harder to purchase homes. That's their way of combating inflation, right? And so the homes are going to start to cool off actually because of less supply. And then with higher interest rates, less demand. And it's going to become one of the key indicators. And so things could turn around really quick. So we have to be careful, but we also have to know that we have time. Myself personally, I sold out all of my oil stock near the high because I think it's late to the game to be looking at oil, though oil is high. I think it's late, okay? I still have my banks that I got into. And because of the interest rate hikes, I plan on making money in my banks. The other stock, which is I'm suggesting that if you're up in gains in hype stock, you might want to look at an exit point or exit price and take your profits and have money. Now, the most money that I have in the market is simply my dollar cost average. At the end of this video, again, I'm going to leave a playlist of 3 portfolios that I put together for you guys. One is high growth, one is blue chip, and one is ETFs. And I've been dollar cost averaging with those like I've been sharing with you guys, but I'm going to continue to dollar cost average through this entire year and all the way through a recession. Okay, so when a recession does come, just like in this chart, I want you guys to mentally get this in your mind. If I'm going to use this dip as a recession. So we all know that this is when COVID-19 hit and everything tanked. If this, let's just say this is the recession. If this is the upcoming recession, do you want to buy here or do you want to buy here? Right? So if we're here and we hit a recession and we go down even more, right? So I would say we're here because we've been in a bear market. So we're not at the top. I would say we're here because we've been in a bear market, and then here comes a recession. So do you want to be dollar cost averaging down here, or do you want to wait for it to come here to start getting some blue chip, some ETFs, or some high or some growth stock? No, you want to start buying it here. All right. And so that's why I'm prepared to dollar cost average through a recession, because after that is over, after the recession is over, all we need is time and patience. Then we will be in another bull market. Eventually, we will get to another bull market, and your multiples will explode on your dollar cost average. Not any company. All right. You got to look at companies that you have high convictions on. And if you don't know any company, I suggest that you watch this playlist that I'm going to have in this box just to give you an idea. You don't have to go with my stock picks. I'm just giving you an idea that you literally can start with at least a minimum of $5 a day. Now, I put $10 a day into all of my stock, and I'm going to continue that. And here's another trick that a lot of you can pull off. Continue to add to your trading portfolio, your broker, your trading account. Continue to add your $5 a day. And you can just keep adding your $5 a day and wait for days like this where you have a negative 500, and then buy all of your, add your days up and then do your $5 a day. All right. Now I'm just doing it weekly because it from here on out, so I can show you guys. But in all 3 portfolios that I'm sharing with you guys, I have a separate portfolio with a lot of these stocks in them. And I'm dollar cost averaging even heavier in those. So my biggest position right now is not swing trading. It's not speculative stock. It's not speculative crypto, but it is dollar cost averaging into what I call high conviction plays. All right, good people, I'm going to leave it right there. Now, here's what I would suggest to you guys that don't have a platform. Make sure you click my link below, and I want you to download 3 links, right? The Webull is one. You want to get stock and crypto there, right? Moomoo is the second one, all right? For if you just want to just hold your stock, right? And the third one is Coinbase for your crypto trades. All right, good people, I'm going to leave it right there, and we'll talk to you later. Live, love, laugh, and learn.